So I think a lot of people in the macro community look at, say, curve inversion and suggest the recession is coming. And if you look at Alf's chart, it has a pretty good track record, right? So oftentimes, let's say when the twos, tens invert, you go into recession. So it's been pretty reliable the past few decades. Whether or not the Fed believes that, it doesn't. I mean, so that's kind of one of the strange disconnects between what's inside the Fed and in the macro community. So Powell was actually asked this pointedly at, I think maybe a month or two ago, and he's like, yeah, well, I mean, we look at this, but we also look at a lot of things, and he does not was he wasn't very clear what the economic intuition of it was, right? So the front end of the curve, it's basically just what the Fed does, and the back end of the curve, that's just supply and demand. So I actually agree with that, and I think it's not so much that the two cents is not a good indicator. Instead, I think there are structural changes in the markets pre and post GFC, and that pre-GFC, you had a lot of private investors in, and they were kind of actively putting their views into the market. Post-GFC, a lot of things are changed, you know. So, for example, you have a lot of government involvement that distorts things, obviously. The other thing is that you have a lot of, and Alpha's talked about this as well, you have a lot of people buying for regulatory reasons, right? You have banks, you have pension funds, and so forth. So those guys, they're not really they're not really expressing any views about economic conditions. They're just buying because they have to. And furthermore, you know, the supply of things in the long end, that's all political. It has nothing to do with economics. It has to do with what Congress feels like doing. So for me, it's hard to have any economic intuition when you're looking at the slope of the curve. So uh, it's not that it's doesn't have anything. I think it just has less information than the past because of these structural changes in the markets. And I suspect actually that, you know, curves can invert and they can uninvert, right? A few months ago, two cents inverted and then they uninverted. I
No,
think as QT goes forward, maybe they uninvert again. Maybe the 10-year goes
you know,
higher. Please.
Joseph, I really sympathize with your risk assessment that QT can temporarily uninvert yield curves in a very aggressive way, even. It really depends how you run it. But if the Federal Reserve, Joe, let's say they would come up and they would say, we don't like this inversion, because then people freak out. We'd like to steepen the yield curve. Let's assume they say that. I can they can easily uninvert the yield curve by a QT if they wanted to. They could, for instance, think of a reverse operation twist, and they would say, okay, we're going to keep the balance sheet shrinking by the same amount, but we're going to actually reinvest more in the front end of the bond curve, and we're going to actively sell some of our longer duration bonds that we have. And some people tell me, yeah, but I mean, look at the Federal Reserve balance sheet holdings. They are not so concentrated in the long end. They don't have a lot of 30-year bonds, so they can't steepen the yield curve like that. And that's because you guys haven't traded bonds. I'm just kidding. But they can steepen the yield curve because 1 billion of a 10-year bond is a very different animal than 1 billion of a 2-year bond. The duration risk that is in that 10-year bond is roughly 5 times as big as a 2-year bond, roughly again. So what that means is that for me, as a former portfolio manager, to take on that billion, I need to have a value at risk, which is much larger because the price swings of that 10-year bond are much larger than a 2-year bond, which means that the same billion of notional will absorb a lot more risk budget from the private sector compared to the 2-year bond. So even if the notional size is not a lot, if they wanted to, it wouldn't take a lot for markets to have to make space for that new risk they need to absorb. And to do that, they need to sell the bonds, basically, make space for the new ones coming. And that would make the price of those bonds go down and the yields go up, and then mechanically steepen the yield curve as well. From this perspective, on a short-term basis, as Joseph says, the Federal Reserve can have quite a strong impact on yield curve dynamics, and the same can be from a private sector perspective. Regulation can have a massive impact on these yield curves. So the chart that I plotted before was not to say, hey, it's below zero, so it means it's not a binary outcome. But what I'm more interested in is the trend. If the yield curve has been flattening for a year relentlessly, it's telling us that, the bond market is basically saying we are going to tighten above neutral, we're going to get restrictive, such that the long end of the yield curve is reflecting this restriction. And I think this trend might have room to go as the Federal Reserve needs to become more and more aggressive. Last thing I'm going to say is the bond market is guiding Powell. That's what's happening over the last 6 months. You didn't have Powell reprice the bond market very often. You had the bond market repricing the Federal Reserve function very often. So right now we are discussing us whether the new terminal rate has to be 4 or 5 or 3.5. Why are we discussing is because the bond market is asking us to discuss by a repricing the terminal rate. And that's what Powell will have to answer, because when he shows up to the wire, guys, on Wednesday, the market expectation will come in pricing the 4% terminal rate. What does Powell want to do? Does he want to affirm those market expectations? Does he want to see them higher? Does he want to see them lower? Anything he will say will have to be measured against those expectations. So the market has been riding Powell. Let's see what he says on Wednesday.
Alf, you got to go now, right?
Yeah, pretty
Powell.
much.
Wonderful.
All right.
Well, I'll just say, before we go, I've been talking to Joseph a lot, so I'm influenced a lot by Joseph. Alf, I think kind of the Fed has been influencing the bond market, which has been influencing the Fed. I think the Fed has been little mutterings here, little mutterings there when they want the terminal rate to go up, and when they say maybe it's gone a little down, Bostic goes out and starts being dovish. But I'll give Joseph the final word. But before I do, make sure you follow at MacroAlf, at FedGuy12, them on Twitter. Joseph's writings can be found at FedGuy.com. Alf's writings, the Macro Compass, on Substack. And also, what was I going to say? Oh, subscribe to the Blockworks YouTube channel. I think this is actually a historic day. We got the most live viewers ever, I believe. So thank you so much. Thank you, Joseph. Thank you, Alf. Most of all, thank you, everyone, for watching. Joseph, I'll give you the final word.
Man, I'm pretty sure Powell thinks he controls the bond market. So I think he would look at this and he's like, the bond market thinks I will do this. And you know what? If he doesn't like it, Powell will say, I don't like it. In fact, I want to be super dovish. So it doesn't really matter, though. I mean, they influence each other. The Fed definitely takes into account what the market is saying. But I think it's been a great conversation, and I think there's so much happening in markets. This is a great time to be in macro. Guys, definitely keep following Alf, keep following Jack, subscribe to Alf's newsletter. Great content, really, really great tutorials on how the market works. And I think going forward in the next few months are going to be probably the most exciting months since the GFC. Oh, okay. At least since COVID. COVID was pretty cool.